Hello, I'm Frank Timons, founder and CEO of Pier88 Investment Company. I'm here to give you our update and review of the convertible bond marketplace in Q1. I'll quickly walk through Q1 performance, what worked, what didn't, explain why convertibles are performing, give a little backdrop on what's going on we think in the marketplace and risk assets, and review our strategy and why we remain very constructive on it. So Q1 21 was an up time for risk assets. What worked was basically everything that didn't work last several years. Low quality, highly shorted names, value companies, companies with depressed earnings over the last several years really ripped. People sold growth assets to fund this trade. And if you look at the Morgan Stanley factor baskets, you'll see growth momentum and high quality names were actually negative year to date. And the laggards of basically the last few years ripped as people tried to play the rebounding economy. Convertibles did what they were supposed to do. And if I can turn your attention to the table below, you'll see the bond performance versus the equity and look at the downside capture. And then we also described the delta. And as you'll see, the lower delta convertibles really did their jobs here and protected on the way down. And we maintain that a convertible bond is a wonderful instrument to play a growth company through because it offers you the upside participation with some downside protection. We're really pleased that our strategies and convertible bonds did very, very well and outperformed again other fixed income instruments in Q1. After a very strong year last year, absolute returns you saw, and our strategies were up over 2% in the quarter, and that we juxtapose that against other fixed income assets, and you'll see most fixed income instruments were down in Q1. You may recall that there was a big move in the 10-year, and many investors understand the whole process as interest rates go up, fixed income instruments don't do well. That's not the case with convertible bonds. They tend to outperform in a rising rate environment because the equity sensitivity piece of the instrument takes over. So what's going on with the core markets, what we're seeing here and why risk assets up? Essentially, it's a stimulus, reflation, rotation trade. Folks are getting bullish because more of us are getting access to the vaccines. There's a belief that there's pent-up consumer demand to travel, go to restaurants, et cetera. We have massive fiscal stimulus going on in the country right now. Some economists would argue we have too much, we don't need more, and we're going to grow 6 or 7% of the US economy. So there'll be a sharp economic rebound, strong positive earnings revisions, which is generally good for risk assets. And the Fed has said they're on hold for a while. So that is really good for risk assets, equities and converts, not so typically good for traditional fixed income instruments that'll be worried about interest rate moves. So how do we like how we're positioned? It's because our strategy really focuses on scarce yield and scarce growth. Our cyclical companies are seeing fundamental improvements in their core businesses, which is a good thing. Our disruptive innovators continue to innovate, grow market share. They delivered strong Q4 earnings and better outlook than the street thought. And our solid blue chips are just great, strong franchises that can hit their preferred dividends with their solid cash flows. And you may recall, our strategy is to marry these blue chip yielding plays with the capital appreciation plays. So we get a little bit of scarce yield and scarce growth in the current environment. And we wrap it all up with an investment grade wrapper. So we have that protection on the downside versus these high yielding type of companies with lower credit risk. So we are constructive on the strategy as we look through the next several quarters ahead. Sean Arajema, my co-PM, Mitch McCullough, our president, and myself, Frank Timons, are always available to chat more. Thank you for listening. Take care.